Amid the wave of modern warfare transforming towards unmanned and hypersonic capabilities, military drones have evolved from auxiliary equipment to core combat forces. KTOS, a defense innovation target, focusing on this track, has become the focus of the capital market with its unique technological positioning and order advantages. Since 2023, the stock has risen by more than 140% cumulatively, significantly outperforming the S&P 500 index and the average of the defense sector. Behind this performance lies the strong driving force of the drone plus hypersonic dual engine and the macro dividend of global defense expenditure expansion. This article will conduct a comprehensive analysis of the investment value and risks of this defense innovation target from the perspectives of business layout, financial performance, industry potential, peer comparison, and valuation logic. Currently, with the continuous escalation of global geopolitical conflicts, the demand structure for defense equipment is undergoing a reshaping. According to Statista data, the compound annual growth rate of the global military drone market from 2025 to 2032 will reach 11.8%. Among them, the United States, as the largest market, will focus on investing in expendable, low-cost, and clustered tactical drones to cope with the asymmetric threats from rivals, such as China and Russia. In this track, KTOS is not a traditional drone assembly plant, but builds a differentiated advantage through technological innovation plus cost control. Its star product, the XQ-58A Valkyrie stealth drone, has on-it price of only $3 million, which is less than 4% of the F-35 fighter jet. However, it can perform high-risk reconnaissance, electronic warfare, and even suicide attack missions, perfectly aligning with the U.S. military's combat concept of large-scale deployment and affordable attrition. More importantly, the company has deeply integrated drones with technologies such as hypersonics and C5ISR to form a complete platform plus system solution. This scarcity has made it stand out in the wave of defense innovation. As of Q1 2025, the company held a backlog of orders worth $1.51 billion, a year-on-year increase of 16%. Among them, the $1.45 billion Mach TB 2.0 hypersonic contract has set a historical record, laying a solid foundation for long-term growth. KTOS' core competitiveness lies in breaking away from the positioning of a single product manufacturer, focusing on high-growth niche markets and national defense, and forming a synergy of three major business pillars. This is different from the heavy asset, high-cost model of traditional defense giants such as Lockheed and Northrop. The first major business is unmanned systems, which serves as the basic foundation for the company's growth and realizes the leap from target drones to combat drones. Unmanned systems are KTOS's traffic entrance and the first business segment to achieve large-scale profitability. In Q4 2024, its revenue reached $270.5 million, a year-on-year increase of 27.5%, contributing nearly 30% of the total revenue. This segment centers on two major product lines. First, target drones. Models such as BQM-167 and BQM-177 provide the U.S. military with training support for simulating enemy targets. This is a rigid demand business with strong order stability. Second, tactical combat drones. Represented by the Valkyrie, it has been listed as a record program by the U.S. Marine Corps and the Office of the Secretary of Defense, marking its transition from the testing phase to the large-scale procurement phase. Compared with competing products, the advantage of the Valkyrie lies in its stealth design plus autonomous swarming capability. It can conduct coordinated operations with the F-35 and is expected to become the core equipment of the U.S. military's Loyal Wingman program in the future. The second major business is hypersonic and propulsion systems, which serves as a strategic breakthrough and creates a second growth curve. If drones represent the current growth, hypersonic technology is KTOS's future barrier. Through independent research and development plus military cooperation, the company has achieved a leap from a sub-contractor to a prime integrator in this field. The third major business is C5ISR and microelectronics, which acts as the company's invisible growth driver and empowers all domain operations. C5ISR refers to the integration of command, control, communications, intelligence, surveillance, and reconnaissance, together with the microelectronics business. It serves as KTOS's technological adhesive. Although it does not directly face front-end combat, it determines the actual combat effectiveness of the equipment. C5ISR integrates drones, hypersonic platforms with satellite communications and electronic warfare systems to form a closed loop of all-domain perception. Command Strike. In Q1 2025, it drove a 10-year-on-year revenue growth of the Government Solutions Department. In terms of financial performance, KTOS shows the characteristics of long-term growth certainty and short-term structural optimization. From 2021 to 2024, its revenue increased from $811.5 million to $1.1363 billion, with a compound annual growth rate of 10.7%. In 2025, it is expected to further grow to $1.26–1.285 billion, a year-on-year increase of 11.13%, showing significant growth resilience. The order-to-shipment ratio, a core growth driver indicator, has long maintained 1.2 to 1. In Q1 2025, the order backlog reached $365.6 million, and the record $1.51 billion backlog, including $1.2 billion in funded backlog, can cover more than 1 year of revenue, providing a safety cushion for growth. The growth rate of high-margin product revenue, such as drones and engines, is significantly higher than that of service revenue, promoting the business transformation towards high added value. Overall, the revenue from unmanned systems and hypersonic-related businesses has accounted for more than 40%, becoming the core growth engine. However, in the short term, KTOS's performance is also under certain pressure. The market score concern about KTOS focus on profit margins. In Q1 2025, the gross profit margin was 24.2%. And the adjusted EBITDA margin was 9%, which is lower than that of traditional defense giants. But this growing pain stems from short-term factors, and the long-term improvement logic is clear. The company is currently in the capacity expansion and technology investment period. At the end of Q1 2025, it had $263.7 million in cash and only $29.5 million in net debt, with a healthy capital structure. In 2025, the capital expenditure is expected to be $75–85 million, which will be used for engine factories and drone production capacity. Although this leads to negative free cash flow in the short term, it lays a capacity foundation for growth in the next 3 to 5 years. According to data from professional institutions, global military expenditure reached $2.7 trillion in 2024, a post-Cold War high, with a year-on-year increase of 9.4%. Among them, U.S. military expenditure accounted for 38%, and the focus is tilted towards unmanned systems, hypersonics, and space. The U.S. defense budget is expected to increase by 13% in nominal terms in 2026, among which the investment growth rate related to drones and hypersonics is expected to exceed 20%. As a specialized supplier in these two fields, KTOS directly benefits from the budget tilt. Specifically for military drones, the global market size is expected to reach $48 billion by 2032. With its low-cost plus stealth technology, KTOS' share in the tactical drone field is expected to increase from the current 5% to more than 10%. In terms of hypersonics, the global market size is expected to reach $12 billion by 2032, with the United States accounting for 53%, about $6.4 billion. As a core supplier of test platforms, KTOS is expected to occupy a 2025 share in this niche market. However, from the valuation perspective, KTOS' forward PE ratio is currently close to 60 times, which is much higher than the approximately 20 times of traditional defense giants. Nevertheless, if KTOS can achieve an annual profit growth of more than 20%, the 60-fold PE evaluation will be gradually digested with performance growth, showing the potential of Davis double play. In an optimistic scenario, if the delivery of the Mach TB 2.0 contract exceeds expectations and the order scale of the Valkyrie reaches more than 1,000 units, the adjusted EBITDA margin in 2027 will increase to 13%. Given a 45-fold EV/EBITDA, there is still as light upside potential compared with the current situation. In a neutral scenario, if the performance meets expectations and the profit margin increases to 12% in 2027, with a 38-fold EV or EBITDA, there will be little difference compared with the current market value. In a pessimistic scenario, if the satellite business is dragged down more than expected and hypersonic orders are delayed, the profit margin in 2027 will only be 10%. Given a 30-fold EV/EBITDA, the stock price may face ascertained pullback. Overall, KTOS is a scarce target in the defense innovation track. It is neither a traditional defense giant that earns steady daily but grows slowly, nor a technology company that relies only on concept speculation. Instead, it has built differentiated competitiveness in the fields of drones and hypersonics through technological positioning, plus order support plus cost advantages. In the short term, the drag from the satellite business and high valuation may lead to stock price fluctuations. However, in the long term, amid the wave of global defense expenditure expansion and technological iteration, KTOS is expected to grow from a mid-level contractor to a defense innovation leader, bringing sustained excess returns to investors. For investors with a long-term perspective, the current correction is an opportunity to deploy in the future of national defense.